What is an expense factor on a bank statement loan? Jim Kennedy here with Kennedy Mortgage in Texas. One of the most important things to understand about bank statement loans is how lenders actually calculate your income. Because it's not as simple as just adding up your deposits. Here's how it works. First, the lender adds up all your deposits over 12 or 24 consecutive months, and then they apply what's called an expense factor. The expense factor accounts for business expenses. It's basically the lender's way of estimating your net income from those deposits. Here's the key part. The default expense factor is 50%. Here's a simple example. Say your deposits over 12 months are $300,000. At a 50% expense factor, the lender uses $150,000 as your qualifying income. That works out to be about $12,500 a month. Now here's where things get important. If your actual business expenses are lower than 50%, you can actually document that with a letter from a licensed CPA, tax preparer, or even a bookkeeper. And the expense factor can go as low as 10%. So a 10% expense factor on $300,000 in deposits, your qualifying income jumps up to $270,000 a year. That's $22,500 a month. That's a massive difference in what you can qualify for. On the other hand, some industries with higher overhead, like restaurants, for example, may be underwritten at as high as a 70% expense factor. So before you apply, talk to your mortgage broker and your CPA about what expense factor applies to your business. It matters more than most people realize. I'm a mortgage broker with Kennedy Mortgage here in Texas. Feel free to reach out anytime. I'm more than happy to help.